Okay, and welcome back to Accounting Information Systems, Marketing, and the Sales Process. Now we are going to look more closely at the credit sales process and its related risks and controls. So B2B, business to business sales, offers a different form. Business credit sales are sales on accounts receivable, meaning that the customer offers a line of credits to its B2B customers. Instead of an immediate recording of cash on the balance sheet, these credit transactions are recorded to another asset account, accounts receivable or AR. Here we see our B2B transactions. So we have here vendors for products, then we purchase these products as the company. We convert these products, usually conversion costs are direct labor and manufacturing overhead, into the product. Then we actually sell the product to the customer. In this case, it's another business. Here we see another B2B or business to business example. As we started with marketing, where we're connecting the product or service to the customer, now we add the pricing and contracts, where we're negotiating price, payment terms, and other sales contract terms. Then we have the sale itself, which is where we're taking the customer order. We are shipping and those goods to the customers. And then we have the accounts receivable or the AR, which is the balance that we have. And then once we collect the funds from the customer. So while the goal of business to consumer marketing is getting the products in front of those potential consumers via possibly web advertisements and marketing campaigns, when we are talking about B2B, business to business, that marketing focuses on finding retail customers to sell in stores. So retail customers are businesses with retail stores where other companies' products are also sold. Here we see our B2B marketing control activities. So here we see that we might have the information or security manager, or even possibly the marketing director, maintain and enforce clearly documented and authorized policies and procedures for user access. Now we see here that our marketing director might use standardized scripts and templates for marketing similar to what they were responsible for B2C. They also might maintain and communicate a marketing schedule to employees as well. Now let's move our shift to pricing and contracts. So marketing processes generate leads for new customers. From there, we try to negotiate prices, and then new customers are evaluated, and then sales contracts are created. So the selling price of products and services are set in this pricing process. And prices go hand in hand with the marketing process. So companies generate interest in their products with marketing, but setting a competitive price that customers are willing to pay is equally important. Now let's look at some pricing control activities. So the CFO would maintain a whistleblower hotline that takes anonymous tips from employees who suspect fraudulent activities. As we've probably mentioned previously, employees are probably the number one group that would commit fraud, but they are also the number one group that would help in reporting the fraud. Here we see the controller or the sales manager might conduct independent checks on price and sales teams members' work. Then we have our HR manager or our human resource manager, and they might require every pricing and sales employee to periodically take vacation so that other employees can perform their job duties. That's also an excellent way to spot fraud. Here we see that we might have the sales manager define roles and responsibilities for pricing or maintain and enforce the documentation of policies and procedures, especially for discount pricing. Then we also might have the marketing and sales director here maintain and enforce those policies and procedures as they relate to CRM, customer relationship management. They also might define the roles and responsibility around the CRM system as well. Now, when we're evaluating customers, so companies check the credit worthiness of new customers before they extend a line of credit. So existing customers are also reviewed to ensure that that credit worthiness is still in good standing. So the credit criterion are basically those factors used to determine the financial strength of customers. And the credit terms that the company gives a customer is dependent on their credit worthiness. So here we have our credit customer control activities. And here you see that the controller would be the owner of maintaining and enforcing that documentation of policies and procedures for the customers. And remember, customers are synonymous with accounts receivable. The controller might also maintain and enforce those clearly documented the credit policies and procedures, which might include a credit application and an approval process for new customers. Additionally, the controller might establish credit limits for each customer based on their ability to pay and capture this limit within an accounting information systems as part of our customer main data table. The controller would also review credit limits periodically and adjust them if the need is necessary, or they might require management approval for credit in excess of those established limits. The controller might also establish one of the easiest internal controls, segregation of duties, between the person granting the credit to the customers and sales, shipping, AR, and additional accounting functions. Now let's move on to sales contracts. So if a company's standard terms and conditions for credit sales does not apply to a particular order or customer, then the amended terms should be laid out in appropriate, legally enforceable contracts that is accepted by both parties and additionally approved by management. And these agreements should be accessible in the customer's records. It's also important for legal counsel to review and approve these sales contracts, especially since they deviate from the standard sales terms and conditions. So these sales contracts, the control owner here would be the director of legal or compliance, and then they're hopefully using standardized, authorized sales contracts that are legally enforceable. Additionally, we might have the director of legal or compliance notify customers that all agreements must be in writing in order for it to be legally binding. Or we might also have that same director of legal and compliance or an HR director that will conduct employee training that covers the appropriate and inappropriate wording when you speak to customers. Sales orders. So once pricing is negotiated and now we have the credit worthiness is approved and we have a sales contract, well, the customer is now onboarded. And at this time, when we receive a sales order, then basically there's no accounting transaction that occurs upon the receipt of a sales order, unless there is a requirement for advanced payment. So then upfront payments are made before the conditions of the order are filled, and that usually gives us the deferred revenue. So our sales order control activities, so the CFO, again, one of my favorite positions, might be responsible for the segregation of duties from authorizing sales from the shipping department, inventory control, and accounting. The CFO might also enforce segregation of duties, allowing only authorized employee to access those sales order input screens or the documents themselves. We might have additional, like we might have the director of sales or the controller or some type of automated IT authorization sequence that would require all the changes to the main customer data table be authorized by management before they are data entered. And we might also have that director of sales or controller or some type of automated IT authorization sequence that requires all changes to the main customer data table to be authorized by management before the data entry takes place. Additionally, we might have the director of sales compare the main customer data to the main employee data to test for similarities and hopefully get us to those fraud red flags. Now, in shipping, when we are talking about B2C or business to consumer sales, delivery drivers deliver the product to the customer's location, or the customer receives it at the counter of the store. And here you see the customer. Here is our sales order that goes into the information systems, which generates a picking request towards the warehouse. So the warehouse picks the products that are ordered. A packing slip is included in the box, and then that box is delivered. So that picking request is basically an instruction to the warehouse employee to prepare the correct quantity and product for shipping to this customer. So warehouse employees prepare an order for delivery. So as part of this process, they use the information that is in this picking request to create the packing slip, which is another document, shows the customer's name, the delivery destination, and the contents of the delivery. And here you see a packing slip example. So information from the sales order is transferred to the picking request and ultimately ends up on this packing slip that is given to the customer when the product is delivered. Now, when we're looking at shipping control activities, you see here the COO, or the Chief Operating Officer, is responsible for maintaining and enforcing the documentation and policies and procedure of the shipments. They also would require properly authorized shipping documents and an appropriate delivery address for each shipment. They would also be responsible for clearly communicating the shipping policies to the customer and to the warehouse delivery personnel, and also ensure that there is documented policies and procedures for investigating and resolving any customer disputes or complaints. You also see that the Chief Operating Officer, or COO, might maintain and enforce those policies and procedures for all shipments, track the shipments, possibly using tracking software, restrict area access to the shipping area, and then possibly segregate the physical shipping location from the warehouse and the receiving location. Then we see that the controller might maintain and enforce those policies and procedures for timely investigation and resolution of those customer disputes and complaints. We also have here that the controller might maintain and enforce those policies and procedures for that investigation and resolution of those customer disputes and complaints. And we might have the COO or the VP of operations maintain and enforce the policies and procedures for the shipments as well. And then we have here our automated systems controls. So these might include the sequence of the shipping documents and the investigation of any anomalies. We might have the ERP system identify any unfilled sales order to see how we can get those orders out. We might also have the ERP system match the goods and quantities from the warehouse to the sales order to show us any discrepancies. And lastly, we might have the ERP system generate the shipping documentation when the sales order is processed. So billing and collections. After it sells goods, a company now has to bill the customer. So the billing system generates a sales invoice using what data was recorded in the sales order, in the picking slip, and in the packing slip that was sent to the customer. So that sales invoice is then sent to the customer with a remittance advice. And so here we see the sales invoice where we see all of the different cookies that were shipped. So in this sales invoice, it includes the data that we got, such as the amount due, the customer, the terms of the sales, and any discounts available. And here we see the credit sales process flowchart, starting with sales and then including our inventory control, production, the role of the warehouse, delivery of the goods to the customer, and then the accounts receivable. And that concludes our lecture. Thank you for watching.